Hello, and welcome to another episode of Phillip Research in 3 minutes. I'm Wee Kuang, research analyst covering the banking and finance, as well as the healthcare sectors. In today's episode, I will be reviewing the local bank's earnings results for the first quarter of 2020 released in May and assess the outlooks for local banks moving forward. Earnings fell between 19 to 43% across the board compared to a year ago, but we observed that banking operations were largely unaffected, with UOB posting pre-provision operating profit or PPOP of similar levels as the previous year, while DBS saw robust growth of more than 10% across each of their business segments. OCBC's decline in PPOP was largely attributed to lower contribution from Great Eastern Holdings. This was a result of mark-to-market losses on shareholders' funds and investment holdings due to a weaker investment climate at the end of the first quarter. As such, weakness in earnings was a result of high levels of allowances undertaken by banks in the quarter. The reason that banks are undertaking excessive allowances is part of building up their reserves in response to the COVID-19 pandemic. This is where the Cumulative GP comes to play, providing a gauge of how much buffer the banks have against potential deterioration in asset quality. Other capital funding and liquidity positions remain healthy and well above regulatory requirements set out by the MAS, signaling no cause for concerns for investors currently. However, most investors may be worried about how business momentum may be affected moving forward. Firstly, if we take a look at current interest rates, both 3-month SIBOR as well as 3-month SOR has fallen to levels last seen in 2013-2014. Net interest margins during that period was also about 10 basis points lower compared to current observed levels. As such, we have lowered our 2020 NIM estimates by 10 basis points across the banks from current levels. This will equate to a 5 to 6% impact on net interest incomes, which comprises roughly 65% of the bank's total income. Secondly, loans growth has tapered to 2.41% year-on-year in March. Consumer loans fell by 2.43% year-on-year, with steeper declines observed in housing and credit card loans, while business loans remain strong, growing 5.52% year-on-year. Moving forward, we expect loans growth to remain at 2 to 3% for the entire year, especially since the government has implemented a slew of measures to support lending. Therefore, considering that operating performance of the banks will weaken over the next few quarters with lower interest rates, together with earnings impact felt as a result of reserves building, we have downgraded the banking sector from accumulate previously to neutral, with revised target prices across the 3 banks. Within the sector, we prefer DBS for its stronger business momentum compared to its peers that can soften impact on its earnings. Their commitment to a stable dividend pegged on operational performance rather than a targeted payout ratio or CET1 ratio also makes it attractive for investors who are looking for attractive yield under current market conditions. And that's all for Phillip Research in 3 minutes today. For more information, you may view the full report on our website, stocks.pnb.com. Feel free to leave a like or share with us your thoughts in the comment section below. Thank you, and we hope to see you again soon.